Hi, Sayantam. Are you able to connect now? Your audio is not coming though. I think you're on mute.
Yeah, can you hear now?
Yeah, now I can hear you. You can try and share your screen.
Oh, that's just wonderful. My screen share is disabled.
Uh, okay, can you try now? Okay, great. So hey everyone. So today we'll be having like a session on quantitative finance and algorithmic trading. So Sayantam will lead the session. So he's currently a data scientist at a fintech company, and he has a lot of experience in this domain. He graduated from IIT Bombay. So, Sayantam, maybe you can start with a small introduction about yourself, and then you can start.
Yeah, hi guys, this is Sayantam Datta. I completed, as Jaren mentioned, I completed my bachelor's from IIT Bombay back in 2014. After that, I went for a master's in computational science from University of Amsterdam in the Netherlands. And I have been working like in the world of quantitative finance since 2017. Initially, I worked with a prop trading company as an algorithmic trader in Mumbai in 2018, and since last year, I've been working as a data scientist in a fintech company where we are trying to predict stocks for trading. Uh, yeah, so over the years, I have gained decent knowledge about like quantitative trading, statistics, probability, finance, and different aspects of finance, and yeah, like data science and all. So yeah, so in collaboration with Link Hub, I'm conducting this workshop today where I will be going through a trading strategy and algorithmic trading strategy in Python. And yeah, so before starting, I would like to discuss a bit about the different aspects of quantitative finance, like what kind of roles are there as for a quant finance guy, and what uh, what kind of knowledge is needed, and what are the skills needed. So let's get started. So quantitative finance industry is essentially divided into two parts. Like one is the buy side firm, and other is the sell side firms. So buy side firms are basically hedge funds, proprietary trading firms, or all those institutions which have their own money. Like they don't handle client side money. Like they don't take money from normal people. Like they probably get funded by very rich people, high net worth individuals, and these are the like organizations which are like hedge funds or prop trading firms, as I mentioned. And sell side firms are like investment banks, retail banks, all the ICICI Bank and HDFC, as well as Bajaj Finance and all such organizations like NBFCs, etc. So yeah, so what kind of jobs exist in quantitative finance. So quantitative finance is like uh, divided into yeah quant finance roles are divided into mm, like different categories. Like one is the most common one is actually the risk manager. So a risk manager is like the guy who is taking care of the limits, like what kind of whether the bank is acting according to the limits set by like the international laws or whatever national laws. So these guys like they have to take care of the exposure, how much bank is lending or how much bank is borrowing, or uh, they take care if there is any default or anything, uh, trading limits and all. So yeah, these are the basic tasks that are done in risk management role. Risk managers don't necessarily need to have a lot of technical background, like they don't need to know programming as such. A lot of risk management tasks are actually done in Excel or Google Sheets, and yeah, it sometimes helps to know to know Python or some aspects of statistics and finance, but that is again not a compulsion. Then comes derivative pricing and trading. So derivative pricing is actually like pricing of options, option like financial instruments. So this role involves a lot of maths and programming knowledge, and yeah, a lot of research is done in in such roles as well. Then there is like structured products, which are more like structuring like loans or portfolio or whatever credit the bank is giving. Um, so yeah, this is again not a technical role as such, not a programming role. Then comes portfolio management. So portfolio management again is not a very initial role, like it's not a starting role. People usually get such roles after multiple years of working in the industry. A portfolio manager takes care of the exposure that a company that yeah, like the he takes care of all the investments and all the trading that is done on behalf of the organization. uh, then comes quantitative research. So quantitative research is actually like a very common role. So quantitative research roles exist with banks as well as other financial organizations. Um, a quantitative researcher like needs to know a good deal of programming, C++, Python, math, statistics. So this is quite a research-oriented role. Other than that, like the other roles, strategy analysis and modeling, again, yeah, these roles exist like in companies like American Express or PwC or Mastercard, where they where you are expected to make like credit card selling strategies based on some analysis or modeling. So it's like a part technical, part strategic role. Technical consulting is like you give some consulting services to other financial organizations. So yeah, this is also a technical role. Credit reporting and analytics again is like a bit like risk management role. So this is a broad overview of the different roles that exist in quant finance domain. But as you might have understood, there is a lot of overlap between the different roles. Uh, so it can happen like you get a risk manager role in with some organization, and you are actually doing like a technical consulting or credit reporting, or you get a quant researcher role and you work as a derivative pricing person. So such kind of overlaps usually happen. So it's important to know beforehand like what kind of tasks you are supposed to do in that organization. while you are performing a certain role. Yeah. So today's strategy, so this workshop, I'm going to talk about trading strategy, a simple trading strategy in Python. The goal of today's workshop is not actually to like come up with a very active trading strategy like which you can immediately deploy and start making money. The goal is rather to go uh, to understand the different aspects of to understand the different aspects of quant trading and of trading strategy, how to calculate the like effectiveness of the strategy, profitability, or how to measure the risk, or how to go about making a strategy backtesting. This is the goal of this of today's workshop. Um, so a bit into the strategy. So there are basically like two windows, short window and long window. Window means basically a quantity that we are calculating. So there is a short window and a long window. Short window is calculated over a short period of time, and long window is calculated over a long period of time. Um, the difference between these two these two windows is called the spread. Uh, Position, what sort of position you take means what kind of whether you are buying or selling, and PNL is like the profit and loss. Uh, then we'll talk about evaluation of strategy Sharp ratio, annualized returns, drawdown, etc. Uh, we'll discuss about it further in the workshop. So let's get started first. So the screen that you can see is actually Jupyter Notebook. Uh, it is available in Anaconda. Yeah, it is available in Anaconda Python. Anaconda. Yeah, and this is like the most widely used ID uh, development platform for data related tasks. If you want to become a data scientist, then you should definitely familiarize yourself with Jupyter Notebook. Um, so let's get started. So this box that you can see, this is called a cell, and these lines are actually like libraries that we are going to use. So so the first line is for resolving some division issues. So sometimes Python throws up some division issues, like if you do 4 by 3, it will show you as 1, or if you do like 5 by 3, it will show you as 2. So we don't want that. We want to have floating values as well. So in order to take care of that, this library is there. Then NumPy library is there. NumPy is like numerical Python. This is the library that is used for all numerical tasks in Python. This is a pretty widely used library. Then comes Pandas data reader. So Pandas data reader is basically a library which is used for uh, which is I mean this library actually gives like stock data from Yahoo Finance. Then there is like Matplotlib library. So Matplotlib is used for plotting purposes. Then there is Pandas. Pandas is the most widely used library for data science tasks. It supports the very widely known data structure called data frames, which is basically a tabular representation of data. Yeah, and it also has other functions. And yeah, like the remaining two libraries are just to suppress some warnings. So yeah, so we have now imported data. module from Pandas data reader as PDR. So let me just show you how this PDR works. Yeah. So to run this cell, I press Control Enter or Shift Enter. So once you press any of these, then you can see like this is the data we are getting from Yahoo Finance. Uh, these are the rows. So there is date row, date column, and then there are like multiple columns: high, low, open, close. These are like the highest value, lowest value, open value, close value on that day. And then there is volume, like how many shares were traded on that day. And then there is adjusted close, like uh, the so adjust means adjusted close is a special column. So see, actually, this is the close on that day, 75.08. But then what happens is companies sometimes they give like they undertake some corporate actions such as giving new shares or mergers or acquisition or dividends or uh, yeah, buyback. So this kind of actions corporate houses take from time to time. So what happens is that then you need to adjust the data in order to have consistency. So it's like, let's say today the share price is 100 and the company decides to merge the shares in the ratio 1 is to 2. So 2 is to 1 means if there are two shares today, then tomorrow there is going to be just one share out of those. So what happens is tomorrow, instead of trading like at 100, starting the trading at 100, the trading will start at 200 because two shares have merged to form one share. So if like in this column you see like 100 and the next value is 200, then it will appear to you that actually the stock moves by 100%. But that is actually not the reality. Reality is that it is just a merger and the number of shares have gone down. So you need to adjust the historical data as well. So once that adjustment is done properly, you will see that there is not much change in the share price. So this is what this adjusted close column does. So we are going to use this column for the workshop. Okay, so let me start with the function now. This is the function. It's called the function is called MA strategy. Means it's a short form for moving average strategy. The function takes parameters, data, moving average, spread cutoff, window, short window, and long window. So these are the parameters that are given to the function. Um, then you have this column called data. From the data column where we are passing this adjusted close value, we calculate the rolling mean over the short window period. So rolling mean means that basically it's like you are calculating a mean, but it's a moving mean. Let's say like you have 10 data points like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then what this rolling mean does is, and if you are putting like let's say 5 as parameter, then it will calculate the mean over a 5-day moving period. Means for yeah, like for every point it will like include like when you are calculating let's say the mean at fifth data point, then it will take like the first, second, third, fourth, and fifth point, and then it will calculate the mean for that day. If you're calculating from for sixth, it will start from second and it will go like second, third, fourth, fifth, sixth. So it will take 5 points like this. So as you can understand, like there is no rolling mean for the first 4 points because we don't have like 5 points in total. So the calculation will start from fifth day and it will like go on till whatever last day is there. So this is what a rolling min does. Um, so yeah, like so we have calculated the short moving average and long moving average using this rolling function where we pass the short and long window as parameters. Uh, yeah, after that we calculate the distance between these two data points, like the short data point and the short moving average and long moving average. Uh, and that quantity is called spread. Uh, then yeah, then we calculate our position. Like then we uh, find out our position. So every time the spread moving average spread goes above the spread cutoff, we take one position. Means we go for a buy, and every time it goes below the spread cutoff, we enter a short position. Means we put -1. So this is what this does, and for this we use where module of NumPy library. Uh, yeah, and then after this we calculate the market returns. So market returns is basically the returns which we get over the entire period of time, like but it's in a series. So we have the initial close, and then we have we have the close shifted by one. So we divide like today's close by yesterday's close, and then we subtract one, and then we multiply it by 100. So what we get is like the percentage change um, in the stock closing price from today, like since yesterday. Uh, yeah, then we calculate the P&L returns. So this is just calculated by multiplying that market returns by position shifted by one. So we have calculated the P&L in returns in this way, and then we calculate the strategy P&L like strategy equity. So this is just cumulative sum plus one, means we are just calculating the everyday. We are just summing up the everyday return, and then we are adding one to it. So if you start with, let's say, $1, then we are just calculating how much is the returns over the entire period of time. And then we calculate the Sharpe ratio. So Sharpe ratio is basically a quantity which is used to measure like the rewards to risk ratio in any strategy. The Sharpe ratio is given by like the mean value of PNL after subtracting, like it's the quantity mean daily PNL by standard deviation of daily PNL, but there is a catch. You don't always use the mean daily PNL directly. Rather, you calculate the mean PNL over the constant returns over the guaranteed risk-free returns. Means, for example, if you put your money in a bank, let's say you get 6% return, then you calculate the mean daily PNL over the 6%, and then you subtract the standard deviation of the daily PNL over the 6%, and this ratio is known as Sharpe ratio. So Sharpe ratio is basically an indicator of how consistent your strategy is, like how what kind of returns you're getting for the amount of risk that you're taking. So the higher the value of Sharpe ratio, the better it is for you. So yeah, so we have calculated the Sharpe ratio here, and then and then yeah, um, we return different quantities from this function. So one is the PNL in return cumulated, and then -1 means we are returning the final cumulative PNL, the market return, and then Sharpe ratio, and then uh, yeah, this data itself. So this this is what the function does. So you don't have to remember all of the points. Like this Jupyter notebook will be made available to you after the workshop, and then you are free to do whatever experiment you want. And also, if you figure out any error, then you're very welcome to point it out to us. Uh, so we are moving to the next cell. Uh, yeah, so there is a short window, like this is where we are describing the parameters. So there is a short window. Short window is created by using this linspace module from NumPy library. So we have a starting value of 5, and then we have 60 as the end value, and then we're creating 12 values in between. And the values are supposed to be integers. So this is what the parameters are. So to give an example, this is what we are getting. We start from 5 and we go all the way to till 60 at intervals of 5, and the values are all integers. So this is what the short window is. Um, then there is long window array, uh, which is pretty similar, like create starting value of 200 and end value of 270, and then 8 values in between. Then there is moving average spread cutoff array, starting from -2 and going till 5, and there are 8 values in between. So these are just the different parameters, and we have created arrays for this. And we are going to iterate over these parameters. Like we are going to pass different combination of these parameters to our function like MS strategy, which we just showed. Uh, yeah, so we have described some data frame here, like one is the results data frame, then one is train instrument data and test instrument data frame. So how this strategy is um, formulated is basically we have divided the entire data into like two periods. One is the train period and one is the test period. So train period is basically the period over which the strategy is like deciding the strategy is being run for all the parameter combinations, and then we figure out the Sharp ratio and the PNL, and then we find out which parameters gave us the best result over the training period. And test data is basically the period over which we are running the strategy, like without having any information of test data. Like this is actually the final run. So let's say, I mean, in any machine learning model, this is how it goes. You have a test data and you have a training data. So the algorithm learns the parameters over the training period, and then you test it out on the test data. Like you check the performance of your model on the test data. So as you can see, the training data is running from like 2012 till 2015, and the test data is running from like 2015 till 2008. So there are like 2 periods of 3 years each. Uh, Now we are doing the optimization of the strategy on historical data. This step is also known as backtesting. Uh, yeah, so we run over the short window array, then we run over the long window array, then we run over the moving average spread cutoff array. All of these arrays are defined here. Then we call our moving average strategy, and we get this output like PNL, market return, Sharp, and then we ignore a output, like ignore a value which is the data. For that we have put underscore. Uh, then we are like uh, inserting all the output into this results DF data frame. So we have created a row here, and then we are appending that row to our data frame. So once this entire run is completed, then we have our results data frame ready, and then we sorted it by sharp. So we want to get the highest sharp possible, and yeah, then we print the highest sharp, the whatever market returns and PNL we got. So this is how the training is done. Now comes the test period. So for the test period, we have the test. I mean, we are taking the test long window value, like by, I mean, we just take the, I mean, whatever sharp we get for the best sharp, we are fetching the parameters and we are assigning it to the test period. Long window, short window, moving average, spread, cutoff. So this is what is done here. Then we again run the strategy, but this time there is only one run with the best parameters, and then we store them in like this many variables, and then we printed it here. And then there is an additional run over the entire period. So this is what is done in this cell. So you can see these are the return values over train period. This is the return over, this is the PNL over train period. This is the Sharpe ratio, 1.37. And over the test period, the Sharpe ratio is 0.97. PNL is this, and market returns is this. And these are our optimal parameters. So we got best Sharpe ratio in training period for short window of 35, long window of 220, and moving average spread cutoff of 2. Uh, so yeah, this is how the training is done. And you can see there is an additional graph here. So this shows how the PNL is varied over the entire period of time. Uh, so the blue one is the PNL in returns, and orange one is the market returns. So we can see that the blue one has mostly been above orange, but eventually the orange one caught up with the blue one. So the market has caught up with the strategy PNL. Yeah. Uh, yeah. Now we come to some analysis about how some metrics about how to analyze the strategy. So we have already seen like one metric which is Sharpe ratio. Other than that, what other metrics are there? So there is a metric like win days, so the number of days when we made a profit, and the other metric is loss days, number of days where we were in a loss. So if the PNL in returns is positive, like if there is a profit, then we call it a win day. If there is a loss, we call it a loss day. So we have calculated the number of win days and number of loss days, and then yeah, we have there is another metric called annualized return. So this is how much return you would have made over if you ran this strategy for an entire year. Then there is mean daily PNL, mean daily FCD, uh, standard deviation of daily PNL, and mean of daily PNL. Uh, yeah. So these are other metrics. Yeah. Then we come to one more metric, which is the drawdown. So drawdown is basically like how much your strategy has uh, lost from its peak value. Means, let's say you are running a strategy. You start with the initial capital of 100, and then let's say it went up to 135, or let's say it went up to 140. Okay, your maximum PNL that went was 140, and then you saw that after 140 it came down to 70, and then it settled at 90. So your drawdown is basically 140 till the 70 move, which is 50%. So your drawdown is 50%. So drawdown is basically how much loss you are making from the highest PNL, from the highest value of value of PNL. So yeah, how do you calculate the drawdown? So this is a simple algorithm for calculating the drawdown. So we have defined a NumPy array, and then yeah, like this NumPy array is this NumPy array of the PNL in returns cumulative is assigned to the variable PNL come from array. Then we have an additional array called drawdown array. Um, yeah, so the drawdown array has is basically an array of zeros of length the same as this array. Then we have a dummy value of PNL, like dummy value for the peak, which is the first value of PNL comes from array. Uh, yeah, then we start from zero, like the zeroth value, and then we keep on iterating. So what happens is now in this loop, what happens is that uh, if the peak value is greater than the PNL comes from array, then we assign it to drawdown array, right? Like we have this drawdown array, we get a new value. So means like let's say from 100 it went to your current peak is 100, uh, but your like you went from 100 till 120 next day. So your drawdown is I mean you don't have a drawdown, you had a new peak. So you assign a new peak, which is done here, right? But if your PNL went down, let's say from 100 it went to 80, then you don't have a new peak, but you have a drawdown of 20%. So this is calculated here. So this happens every time there is no new peak. But if there is a new peak, then the drawdown is zero. But we have a new peak and the value is assigned to this peak. So I hope it is clear how the drawdown array is calculated. The maximum value that is stored in this drawdown array is the drawdown, and this is here. So these are the values. We had 676 winning days, 610 losing days. The annualized returns is 126%, and this is the mean daily PNL, standard deviation of daily PNL, and this is the maximum drawdown. So our strategy saw a maximum loss of 57.48% from its peak value. So this is how the strategy is designed. Uh, yeah, so I'm open to any question now. If you guys have any question, you can post it. Yeah, so there is a question. The code, yeah, the code will be given to you after the workshop.
Yeah, if anybody has any other questions, they can even unmute and ask if you want to do that. So, as Sayantam mentioned, he's also doing a project-based course for Quant Finance. So you can check out that if you're interested in this field and you want to get started with by doing a real project. So if you have any questions, then we can take that up now.
So I'll give you guys a brief intro about the course. So the course is basically divided into 4 weeks. The first week we have like some basic lecture on Python and basic statistics and distribution. The second week we discuss like the basic concepts of finance such as stocks, futures, and options. Then we also discuss about like put call parity, Black-Scholes model. Then third week we get a bit into machine learning, like we try to understand from scratch how linear regression and logistic regression works, and what are the metrics in I mean what is classification and regression, and what are the metrics used for calculating the performance of models. And yeah, like there is one big project that is done as part of this course. So it is usually introduced in the second week. You will be given the data and then you're supposed to complete the task. So the project is basically a quantitative research project where I guide you in like doing a real world project. And yeah, like if you are looking to like this course and this project will be very helpful for you guys if you're looking to enter quant finance industry. So irrespective of whether you are a college student or a professional employee, this project will give you decent knowledge about Python and how data analysis and statistical analysis is done in the world of quantitative finance. Yeah.
Great. I think we can wrap it up. So I think most of you are there in the Telegram group also. So if you have any questions after you check the code, you should try it out on your own. If you have any questions, you can ask there, or any other questions in general about the field of quant finance. You can feel free to post in the group. And meanwhile, I have shared the link of the course that Sayantam was talking about. If you have questions on that, also you can ask either directly to Sayantam in the group itself, or you can ask in the group. Okay, great, Sayantam. Thanks for joining. Thanks, everyone.
Yeah. Thank you.
Bye.